Thank you, Melis. Welcome, everyone, for the last panel, and thank you for your patience. I was expecting this number, actually. Thank you for being here with us. We've been discussing about post-growth entrepreneurship, degrowth, and new ideas and new initiatives that are waiting for our future. And we have very visionary, inspirational, and trailblazer people here since yesterday with us. I would like to ask questions. First, I'll start with Melanie. And we heard her inspiring story. I'd be very happy to hear a bit more detail about how did you start? And how did you establish the non-profit company? I have a not-for-profit company, and it was a big challenge for me too. And it's a big challenge, and it needs dedication and persistence, and you don't get approvals at the very beginning, especially then you have to show yourself, prove, and then you can start maybe scaling your organization. How was it for you? Why did you make that decision? And then you also mentioned about the other organization, Not-for-Profit Ventures. That one is, how old is it? And how do you see it, the future?
Oh, is this on? Okay. That's a lot of questions. I guess I'll start with how did I start Radically Open Security? Oddly enough, it actually started with an angel investor offering me €500,000. Jan Mark. He was actually a great friend of mine. I knew him from my computer science PhD. I very much appreciated his kind offer, and I turned him down. And to this day, I have no regrets, of course, having turned him down. But it's kind of interesting because actually his offer of investment, in a way, kind of launched my company. I like to compare the bootstrapping process for companies actually to, I don't know if you're familiar, it's this child's story, it's a parable called The Stone Soup. So I'll tell it quickly. So there was this poor man who was walking on a country road, and he didn't have any money, but he was getting really hungry. So what he did is he picked up a stone from the side of the road, and then he saw a farm, and he went down the driveway and spoke to one of the farmers. And he told the farmer, you know, I'm going to make the most delicious soup you have ever tried. It's called a stone soup, and it is going to have this stone, but it's also going to have carrots, and it's going to have chicken, and it's going to have barley, and it's going to be the most delicious thing. Now the farmer, thought about it and said, that sounds interesting. What do you need to make this soup? And then the poor man said, well, all I need from you is carrots. And then the farmer said, okay, I can provide you with some carrots, And then the poor man went back to the road, continued walking, went to the next farm, went down the next driveway, saw the other farmer, told exactly the same story about, so I'm going to make this delicious soup, and it's a stone soup, and all this and this and that, and all I need from you is the chicken. And the farmer's like, great, I'll give you the chicken. And then he repeats this again, next time for the barley. And then this story has a happy ending. I mean, basically, he collects all the ingredients that he needs, and then they make the soup, indeed, and then they all share it together, and it indeed is as delicious as promised, right? Happy ending. So that's the stone soup parable. Now, I believe that this is actually what bootstrapping a startup is like. And oddly enough, with my own story, I started with a stone, which was basically this investment offer of €500,000. So what I did, at first, I made a list of the most brilliant hackers that I knew. And I went to the very first one, and I said, I'm thinking of starting a cybersecurity company, and how would you like to start a company with your friends? I've got this investment offer of €500,000, and, I'm going to be, talking with this guy and this guy and this guy, and, wouldn't it be a lot of fun? And then the first guy was like, oh, that sounds interesting. interesting. $500,000, you said? Okay, great. You know, I'll think about it. Then I went to the next guy on the list and basically said, yeah, so I've got this offer of $500,000, and then like I already spoke with this guy, and I'm also talking with this guy and this guy and this guy, and the second guy was like, oh, really? You already? This guy's already thinking about it? That's interesting, you know. And then I went basically through all of the hackers on my list, and then eventually, like, they were all thinking about it because the other ones were also thinking about it. And then I went to my first potential customer and I said, hey, you know, so I'm thinking of making this cybersecurity company, and I've got like these 7 guys thinking about it right now. And of course, the first customer was like, well, you know, we don't know what this company is going to be because this is brand new. But if you've got these guys potentially involved, then that's actually really going to be quite interesting. So, you know, so then, so yeah, sign me up. And then I went to a second customer, same thing, got the, you know, the second customer to sign up. Then I went to the third customer, then got the third customer to sign up. Then I went back to my friend Jan Mark and I said, you know, Jan Mark, I love you, but I don't need your money. However, I would really appreciate it, though, if you could still join as a co-founder, because I would like to have you around, and I would also love your business expertise. You're not getting any equity, but and he agreed. So he was indeed one of the 7 co-founders on my team. And in a way, you know, I was like that poor man, you know, that was on the road, and that stone that I picked up, I mean, that was basically the offer of €500,000, and then I basically collected all the ingredients that I needed, you know, both from the hackers as well as from the customers. And in the end, I discarded the stone. That's how we started it.
Wonderful story. Thank you. Ayşe, you are the co-founder of Impact Hub Istanbul, and you have a great contribution to the social innovation and impact investing field in Turkey. What's your story? I know that you were in finance before, and how did it come up to establish an Impact Hub in Istanbul?
Actually, the quote that Melanie made earlier in the session, in the previous session, applies really well to my career path. You said business is one of the best forms of, most effective forms of activism. I think that's what I realized throughout my rather short career path. I actually studied computer science as well, like Melanie. I had no talent in it, but I realized I understand a little bit of business, more soft skills or social skills. So I went into banking for about 5 years. Didn't know about like concepts that connected to the social impact field, such as microfinance and other topics. And 5 years of banking taught me a lot of things, but I realized banking is not going to save the world. And through a lot of volunteer activities, I just discovered a lot of different concepts, and social entrepreneurship and impact investing were some of those. And I actually fell in love with it because I realized business itself is not going to save the world, but business that has a purpose may do some good. So I actually basically went into, started discovering more within the social entrepreneurship ecosystem. And in 2014, while I was in that discovery phase, I actually met with my co-founder, Semi, which both of us met with the co-founders of other impact hubs in different parts of the world. And we realized it could actually serve a big purpose in various different countries, which also apply to Turkey as well. Our story is quite similar to Melanie's on how she started her business, because when we had to write up a feasibility study to apply to the Impact Hub network, but after that, it was all on to us. It was quite an autonomous mechanism that we had to form in the specific country that we were starting Impact Hub. So in 2015, I think within the course of 9 months, we probably talked to 300 to 400 people, had teas, had coffees, had lunches, telling them about Impact Hub, which we didn't know how it was going to be formed really well either at the time. But we were telling them a vision, and they were really into it. And some of these people that we've talked to are actually in this room. And they actually joined into our journey. We started doing various different workshops, dreaming how Impact Hub Istanbul should be formed. And that actually served a big purpose in our first 6 months. some of those people that we've talked to, they became our customers, they became our part of our community, our paying members. And some of those people that we talk to now are our customers that we do projects with. And some of them, they just support us because it was a quite difficult journey in the beginning. As Serra also knows, and some other people in the room as well, when we started Impact Hub in 2016 in Turkey, the social entrepreneurship ecosystem was not thriving yet. The people that were in the ecosystem, they were, they were doing their own things, and they knew what social entrepreneurship was and what their impact was going to be, but they couldn't raise their voice as much. So various support mechanisms were needed from the public side and from the private side. Luckily, we're getting there slowly. We're in a better stage, I could probably say, but it was quite a tough journey, and the community that we built in the beginning, our customer validation phase, was quite helpful in beginning of our journeys. Maybe I'll talk about Impact of Istanbul later on.
It would also be great if you can mention about the new initiative, the Impact Investment Initiative. Would be great after this.
Yeah, sure.
I had another question, but I'll change it since you mentioned a lot about your enterprises. I actually want to ask you, what's the difference between social entrepreneurship and post-growth entrepreneurship? First question. And can we invest in not-for-profits? Can we?
So, thanks for the question. In answering this question, I would like to refer to Muhammad Yunus, who many could sort of call the father of social enterprise. For those who don't know, he's a Nobel Prize-winning economist from Bangladesh who invented microfinance and started the Crimean Bank. So he also wrote this book called Building Social Business, and he defines social business as follows: dividend-free companies for solving human problems. Now, the world loved all this talk about solving human problems, and thus launched our social enterprise ecosystem featuring such gems as, impact investment and selling our B corporations to Unilever. But the whole dividend-free part of it, well, we kind of forgot about that. But this is a problem, and this actually became a big thorn in Muhammad Yunus's side because he even intended microfinance to be dividend-free, to be, financially non-extractive. And yet many people who started microfinance institutions wound up instituting higher, more predatory interest rates than even normal banks, and even they were having IPOs, and it got Yunus really pissed off. Anyway, but I would say that, in that sense, that is the difference between sort of post-growth entrepreneurship and social enterprise. I think the social enterprise, it has good intentions, but it's trying to really maintain this triple bottom line of people, planet, profit. And it's all well and good, except for the fact that that profit also incorporates extractive profits. And that's sort of the greenwashing that makes its way into social enterprise. So the problem is we've taken on too many of the tools of Silicon Valley in the social enterprise ecosystem, but we can fix it. And it's not to say that, the people don't have really wonderful intentions. Generally, they do. But the problem, though, is that most people don't actually understand the nature of the problem. And, the other thing also is just even in our semantics, talking about profit, the word profit, it has a double meaning. On the one hand, what I would call reinvestable margin. I sell something to you, there's margin on it, I reinvest that for growth and stability of the business. That's the first definition of the word profit. The second definition of the word profit is financial extraction, and that pays for my Lamborghini and my private jet, right? But it creates a lot of confusion in our heads, because as soon as, that startup founder says, well, of course my business needs to be profitable to survive. If you're talking about reinvestable margin, totally agree with you. But if you're talking about financial extraction, not only is it embedding toxic incentives, but it's actually a a competitive disadvantage on the market, because cash you pull out of your business is cash you don't have left over for R&D and paying people properly and making better products and services for consumers. Now, it also creates equal confusion for anything not for profit, because with nonprofits and NGOs, we understand that there shouldn't be financial extraction, but then we incorrectly assume that there also shouldn't be reinvestable margin. And this causes nonprofits to get caught in what I would call the subsidy trap. And most NGOs are dependent on subsidies and donations for their income, but these are extremely vulnerable and uncertain, income streams. And the problem is, the moment that an NGO wants to move over to more sustainable funding sources like business, then the tax authorities get on their case, and then they're like, bad business, and then the NGO is at risk of losing its charitable status. And the moment that an NGO would lose its charitable status, this is like a life and death situation for an NGO, because then the donations are no longer tax deductible. So basically their one funding source that they did already have basically is at risk of drying up. Now, the third problem with this double meaning of the word profit, of course, then is with the triple bottom line of social enterprise: people, planet, profit. Oh, but wait, there's that word profit again. So if you actually break it down, what we have is people, planet, reinvestable margin, financial extraction. So the real triple bottom line that we need in social enterprise is people, planet, reinvestable margin, and that financial extraction, that's the greenwashing. So if you want to eliminate the greenwashing from social enterprise and ESG, it really is as simple as getting rid of the financial extraction.
Okay, and to add to this, not-for-profit and venture together, as a terminology, it's a bit radical, because normally we know about impact investing, but investors, they want profit. So not-for-profit ventures, I mean, what does it mean exactly?
So with nonprofit ventures, I think that there's a couple ways you can approach things. First of all, nonprofit ventures, the incubator I started like 4 or 5 years ago, it is meant to pump out businesses that are a bit similar to Radically Open Security or Patagonia, for that matter. It's like we're pumping out small Patagonias, basically. We have a focus on nonprofit entity forms, steward ownership, and cross-subsidizing charity with our profits. We've incubated almost 60 startups across four cohorts, and the call for applications for our 5th cohort opened a couple weeks ago. We already have over 50 applicants. It's crazy. So, but truthfully though, we start as being a bootstrapping incubator. So we actually teach founders how to bootstrap. But I can already hear the protests. What about the things you can't bootstrap? You can't bootstrap everything. You can't bootstrap a power plant, for example. Like, that's true. You cannot bootstrap a power plant. But there's a couple ways that we can address this. One is that we need to figure out how to reform the finance industry. I made before kind of a bit of a sarcastic comment about impact investment. But the problem with impact investment is that we don't think often enough about the compensation structures that are underlying it and the financial incentives that it creates. So in the investment industry, the typical way that finance managers are compensated is with something called the 220, 2% asset under management fee, 20% carried interest. I'll explain what this means. So with the 20% carried interest, if I am a VC and you are my portfolio company, if you grow exponentially and exit, I get 20% of that. And that is a super powerful motivator for me as a VC to push you to grow exponentially and exit. In fact, you can say that the carried interest embeds the growth imperative into startups. So if you want to actually get rid of the growth imperative from startups, it really is as simple as eliminating the carried interest from the compensation structure of the fund manager. Now, the 2% is also extremely extractive. People think the number 2 is small, but they don't understand compounding. If you think about a 2% mortgage, mortgage. You start getting a bit of a gut feeling of how much that is. But if I want to retire someday and I put my money into a Roth IRA or 401k or some kind of like, investment fund with a 2% management fee, given the historical performance of the stock market over the last 25 years, given a 2% management fee, I will have given literally 2/3 of my returns to the fund manager. Most people don't know this, but John Bogle, who is the CEO and founder of Vanguard, used to talk about this all the time. He called it the tyranny of the compounding fees, and it was part of the reason why he invented the index fund. It was because he was basically trying to, by passively shadowing basically the stock market index, he was trying to take all of the brain power and the human element out of investing so he could effectively be able to drop fees down to zero, more or less. And it worked. Of course, people called it Bogle's folly, when the index fund was first introduced. But I mean, Bogle's folly, really? Because of course now, index funds and their superset of exchange-traded funds, ETFs, in other words, passive investment, is now 35% of all investment globally. And Vanguard, of course, is one of the 3 largest asset managers on the planet. So clearly, John Bogle had the last laugh here. But he was actually trying to create not-for-profit investment funds, which is quite interesting because people think that idea sounds strange, but it has quite a storied legacy. So what you can do is you can take that extractive 220 and instead you can reform it. So it starts with getting rid of the carried interest. Then you take that 2% and you can do, for example, what Snowball Impact Management from London did. And after getting rid of the 20% carried interest, you change that 2% into the cost of running the business, assuming middle-class salaries and a pension. Because God forbid fund managers be middle class, right? So, and at that point, you've basically got enough, in fees to be able to actually run the business and pay people middle class salaries, and then all excess returns or fees get recycled back into the fund so it can actually focus on what it is really meant to be doing, which is incubating impact businesses. The other thing also is Snowball. Also, they hung themselves underneath a foundation, so adding an element of steward ownership. And that's basically, I think, how you would reform an investment fund in such a way to also make it not-for-profit or financially non-extractive. So I think for the impact VCs that are out there, this is actually what we need to do with the finance industry. So for those companies that you cannot bootstrap and you need to get them sources of funding, I wouldn't want them to go with commercial VCs, but I have very few problems with them going towards a financially non-extractive VC. Such as Snowball. Also, Purpose Ventures from the Purpose Foundation in Germany also has structured their fund in a similar fashion. But the problem, though, here is that it's actually difficult for fund managers to go in this direction because then limited partners, particularly the institutional investors, get really confused because the moment you start doing things like altering fees, then they start thinking, oh, incentive misalignment. Because they've got this really odd thought that the greediest fund manager is somehow also going to perform best for them, when if you actually really think about it logically, low fees, hello. Like, do you want to pay more in fees, really? And on top of that, by eliminating the conflict of interest financially between the fund manager, basically between the GPs and the portfolio companies, and between the GPs, the fund managers, and their limited partners, their customers, you are de-risking the whole thing. So let's see, can you say better risk-adjusted returns? So, I mean, the fact that pension funds and other institutional investors do not find this attractive is incredibly perplexing, because if this were to be successful, this would put downwards fee pressure on the entire finance market, which would be good in the end for pensioners and everyone else. But the problem here is that anything new is perceived as risky. So I think it starts really with education. It starts with educating fund managers that you can create financially non-extractive, not-for-profit investment funds. And I think some of them would go out on a limb to create it, just like a bunch of CEOs of steward-owned companies also go out on a limb to give their company away. But we do need to educate particularly the institutional investors about the fact that these kinds of things are worth supporting, because the problem is right now the GPs that try it, they get stuck in a chasm of 30, 40 million and can't get out because the institutionals won't touch them with a 10-foot pole. So anyway, but these are like really fundamental things in finance, and these are leverage points that I think if we can do something with this, I think we've got a real chance of being able to reform finance in a way that it can really help to build also the post-growth economy.
Thank you. I wish we had more time. You're like a school, really. There's so much to learn. Thank you. Ayşe, I'm really wondering how you're seeing the situation right now, because if you remember 10 years ago, the businesses that you were supporting as the incubator were not mature enough, they were not seen investable, but right now we can all see that there's a great vibe that more young people are interested in building their companies, doing good on purposeful businesses with socially and ecologically impactful missions. How do you see it? How is it growing? Are these new concepts, do they have a foundation in Turkey? How do you see the situation?
I think somehow the organizations that have been attracted to the field of social enterprises, impact entrepreneurs, are looking through a popularity lens. I think the field has become, through the trending of SDGs and the climate anxiety, etc., all these various different social and environmental problems, I think this field has become so popular that everybody wants to see that social enterprises are the next thing, that they're going to solve, all of our problems. I don't think that's the case. And because of that, there's a misjudgment towards the state of the field. It is true that the number of social enterprises have grown, have increased in Turkey, and that are working on various different models. But from an attraction point of it, from a supply perspective, I don't think it has increased that much. I think what has increased is the private sector, because of the attractiveness of the social enterprise field, they are interested in supporting it, which is great, because they are in a way providing grant funding, and yes, they are doing their financial extraction, but they are providing various funding into the field, which is great. But at the same time, we're not supporting the journey of the social enterprises. And we're seeing a lag of social enterprises after they start their journey. They get to bootstrap a little bit, they get a little bit of funding from the private sector, but after that, they have a huge difficulty, and we can see it in various different research reports locally as well, that they have a difficulty keeping themselves financially sustainable. And we can both refer to this from the high growth, the entrepreneurs that see themselves as high growth, the entrepreneurs that see themselves as more lifestyle or post-growth entrepreneurs as well. And this issue applies in the impact investing space in Turkey as well. It is still a very nascent space in Turkey. I can name only one or two impact funds that call themselves impact funds, and also invest in so-called impact entrepreneurs. I don't think majority of them, some of them are, but still, they call themselves impact funds, and they're doing great work. But the rest of them, the talk about impact investing in Turkey is still not there. It's still majority of the institutions, they're talking about impact from the perspective of investing in infrastructure work, investing in the work that potentially the government needs to be supporting. So there's a big bubble around impact investing in Turkey right now that everybody's talking about it from a very high level, and nobody's really yet talking about it about what type of mechanisms, like the mechanisms that Melanie mentioned, what type of mechanisms what we can create that can support our local ecosystem, because each ecosystem is in every country is different. Our country has its own problems and own macroeconomic problems, so we need to create models or maybe mimic models from other countries that can work in Turkey really well, because currently it's not, and majority of the social enterprises that we see are trying to make it work through some of the funding that comes from these impact funds and maybe some VCs as well, and they go on a mission drift. Or they try to bootstrap, and some of them get to be successful, but some of them, they're struggling a lot, and at the end of maybe 4 or 5 years, they say, okay, I give up, this is the end of my game, I can't, this is the most resilient that I can be. So I think we are going through a great path in terms of our ecosystem. It's thriving, but in terms of impact investing, we still have a lot to learn about how to fund our own social enterprises. And we have seen this. I'm quite new to the concept of post-growth entrepreneurship, by the way, but what I've realized after listening to Melanie is we have been around for 8 years now, and what we have been applying methodologies in our own programs based on what we see with the social enterprises and the social entrepreneurs based on what they need. And there's a group of post-growth entrepreneurs, there's a group of impact entrepreneurs that in their nature that can be high growth without the financial extraction. So we try to cater our programs based on what their needs are. And lately we realized the financing is a huge gap still, and the European Social Enterprise Monitor research says that as well, and that applies to a lot of different European countries as well. So we have been playing around with what type of financing mechanisms we can support in addition to our incubation programs, our acceleration programs, because that's great, but when it comes to funding, we can't support them as much. And connecting them to investors is not going to help them that much, because investors are not educated as much in terms of the right way of impact investing. So we started a program called Impact First recently. It's our own homebred incubation program. We accepted 5 entrepreneurs to the program. It's its first cohort. We usually do our programs with the funding, with the support and strategic partnership of private sector institutions or non-governmental institutions. This time around, it's all homebred. We want to create a financial sustainability model behind it eventually, but we made it our own playground to see what type of innovative mechanism we can put in terms of both supporting with the necessary content, necessary support mechanisms to the entrepreneurs, as well as the financing mechanisms. We'll yet to see how it unfolds, but we're excited about that journey now.
Thank you for sharing this. We don't have much time left. I'm sure you have questions. So it's been more than an hour and a half that we've been discussing these issues. Does anyone have 2 questions only?
2 questions? Yeah, I see one there. I really like your questions, by the way.
Oh, really? Thank you. And I really like your presentations. Yeah, thank you, Melanie, and thank you, Ayşe and Serra, for this is a really for me it's a kind of a newish concept right now, and we are, as many of you know, we are a tech company, tech cooperative, and we are mostly comprised of technical people, and we are a little bit, in my opinion, weaker on the finance side and the finance knowledge. So this has been really like a school for me right now. I'm not sure my partners have the same feeling, but for me, we have been really skeptical about going to investors, and because, as you said in your presentation, we don't want to have a boss. But when you have an investor, then you do have a boss, and we cannot combine these 2 concepts together. But when I listened to you, I felt a little bit more relaxed, and maybe there are other ways to approach this, and then maybe we need to know more about it. So what can be? I mean, you talked a lot about things, but what would be your advice for a small? We are 9 people. We are a cooperative, and we have been 4 years active right now. What would your advice would be to a cooperative for us, like us, to be like financially? What should we do? Should we get I don't know, a partner who is finance savvy or something? I don't know. Thank you.
All right, thank you for your question. Yeah, I mean, techies really have a hard time with money. I'm not an exception to that, by the way. In either case, if you don't have those skills, I mean, you need to certainly partner with people who do. My company would have completely gone out of business by now if I hadn't partnered with finance folks. The other thing also is you're saying, like, how do we actually make money and how do we avoid investors? And I think it really starts with lean startup. So, I mean, it really starts with just start small, create MVPs, collect validated learning, actually sell something to somebody, you know, pivot to follow the pain in the market and iterate. I think that works. The problem is that when techies receive a big chunk of change, we will build the most glorious technology as we see it in our heads because we are totally in love with technology. And it's only once we've almost used up the money that we start like wondering, gee, I wonder if I can sell this thing. Right? And then we start asking around, hey, you want to buy this? And then we start hearing crickets. You know, and then most of the time that's about the point where the company fails. So I believe that getting capital too early creates a product market disconnect. And but the thing is, though, I understand if you want to develop products that you're still not necessarily going to want to, you know, it is capital intensive to develop products. I think the easiest way to do it, honestly, is to start a services company and then basically crowdfund the production of your intellectual property by selling services. Because then, just like as with lean startup, you wind up actually creating a product that's shaped like the market, and then you're crowdfunding basically the production of that IP via the revenue from paying customers. That's how I did it with the intellectual property in my own company in Radically Open Security, and it also enabled me to give away our intellectual property. We created this thing called Pentext, which is our pentest automation and reporting framework. Not only did we open source the whole thing, but we made it an OWASP project. For those who don't know tech, OWASP is this umbrella organization of web pen testers globally, if you know the OWASP top 10. And anyway, doesn't matter. But the point is that, you know, I was able to open source it and give it away for free because there was no VC to tell me not to. So, and I think that's sort of the way you can do it. Yeah, at that point, I mean, of course, there's some things you can't patiently create in such a fashion. And coming back to the earlier, what about things that are really resource intensive? And of course, people were before like, well, what about the power plant? Yeah, indeed, you can't bootstrap a power plant. But in that particular case, you've got government funding. And then I think it falls into a different category of thing that you're trying to create, because then you wind up falling into what I would call the Mariana Mazzucato problem, you know, because she basically wrote a book called The Entrepreneurial State. And her thesis is that the government is the world's largest VC, and we're socializing the costs but privatizing the benefits. And if you consider how we're doing this, you know, the government wants things to happen. It could be fundamental research, it could be schools, bridges, roads, you know, they don't want to bootstrap anything, they just want to pay somebody the money and have the problem be done with. So in those particular cases, oftentimes it goes to either commercial fund managers who extract fees out of the whole thing, or it goes to like Big Four consultancy firms who then, like, you know, also extract a whole bunch of money, thus leading to projects being delivered over time, over budget, and with scandals. So I think, honestly, steward ownership and financial non-extraction is also the solution to this Mariana Mazzucato problem. Because if then the government wants to create this thing, whether it's a bridge or whether it's fundamental research, then basically if they give it to a financially non-extractive fund manager or a financially non-extractive disruptive company, then at that point, they're going to be completely focused on actually really solving the problem and reinvesting everything to fully solve the problem. And you're probably going to get the best outcome for the government and also for the citizens. And on top of that, also, there's a governance problem also when they fund companies, because then oftentimes you're creating these innovations and then it winds up getting sold to investors or other entities abroad, and then it's no longer serving the local market. Anyway, but coming back to your question really about with products, I think that basically the approach in a nutshell is basically the steward ownership, you know, to basically lock down your governance, but then the form with the strong asset locks of steward ownership. And then in terms of like, how do we do it without capital? We'll either get non-extractive capital or just like bootstrap via lean startup. This isn't necessarily the answer that everyone wants to hear, but it's just, you know, it takes a lot of doing to be able to find product market fit, and building too much stuff early makes it also hard to do this. So I think that's the best I can tell you.
Thank you, Melanie. Any other questions?
Thank you. So I was wondering, how are you, or how can we actually reform the finance when it is already fed by those MBAs that are claiming themselves as we are doing innovation for change, but still in the same mindset? So, because I think those MBAs are feeding the finance sector, because they are the ones who should shape this reformation, but they are not doing it. So, what is your opinion on that?
So I think it's really a question of getting mind share, and we've got a clash of narratives here. I mean, the first narrative, which is funded by people with a lot of capital, is that all of this extraction and all of this venture capital is sexy. That's the popular narrative. Then, you know, you've got the other narrative that says, wait, but let's apply a systems thinking lens to the whole thing, particularly to social enterprise, because we all have this intuitive feeling that stuff actually isn't working, but just most people don't understand and can't actually explain how it's not working. Now, the thing is, once people understand how the system works, and once they hear about these ideas, they can't unhear it again. You know, and the vast majority of people, including the MBAs, you know, I've gone to finance conferences, including ones where impact VCs were present, and I was asking them, hey, have you ever thought about applying steward ownership to either your fund or to your portfolio companies? And the number one answer that I get back is, what is steward ownership? They just don't know. So the first problem is, it's not even that they're against it. It's just that they just don't know. They're completely ignorant to it because they haven't heard about it. So I think like step one starts with education. I mean, if impact VCs haven't even heard of steward ownership, then we very clearly need to be talking about it. And I think, you know, we can all play our role in spreading these narratives from where we're standing. I think it also requires changing education. And this is part of the reason why not only that I created nonprofit ventures to act as an example for incubators, but I also created the post-growth entrepreneurship class at the University of Amsterdam Business School. I launched this 3 years ago. We taught also already our second class to 120 third-year bachelor students. It's part of the economics and sustainability minor. And the class is popular. It's actually been fully enrolled, sold out for 2 years in a row. We literally had to turn students away, which sucks. But the point is that we've already spread this post-growth entrepreneurship class also to our second business school, the degrowth masters at the Autonomous University of Barcelona. So actually just last week I finished teaching the second course in the degrowth masters. The course is called Degrowth Entrepreneurship. I mean, okay, different word, but same thing basically. And what I'm also doing right now is I'm also on something called the PGE Roadshow. I'm actually going to as many business incubators and business schools as possible to try and convince staff and faculty that, hey, there's this new thought, this new line of thought. This is the bleeding edge. Like, you need this class here too. You know, and I've also made the materials available for free. So I recorded 2 years ago my post-growth entrepreneurship class. I made professional video recordings. I got a professional editor to edit them. And we put the classes online on YouTube for free with a Creative Commons license. So if you all like my presentations today, I would heartily invite you to check out those videos. It's 11 hours of material. So it's a long sit, but it's literally the entire class.
I watched some of them. They're really good.
Thanks. So, you know, and I think that's really what it is, because I think once this idea spreads, then I think in a sort of kind of viral fashion, we can each from where we're standing take the pieces that work for us, discard the pieces that don't, and then use that, you know, to influence our direct environments. And I think, you know, in that narratives, it might be slow in spreading, but look, we're in the internet age now. and the fact is that, you know, if it's 6 degrees of separation between everybody, then, you know, it doesn't take that many orders of, you know, spreading things to really be able to get the narrative out. And I think that's where it starts, and change does come quickly with this kind of virality. So I think it's just really then a matter of just thinking, what can I do? So think globally, act locally, and in your own community, also in Istanbul, you know, here in Turkey, what can we do, you know, to be able to create financial non-extractive businesses and financial institutions and incubators? I mean, each of us from our own place, you know, we can play our own role. So,
thank you so much. Before finalizing, I'd like to hear from Ayşe too about this. Since your background is finance, how we can change the mindset of these MBA people?
I had an MBA as well. But it was to focus on social entrepreneurship and impact investing. I think Melanie is right. I think it's all about education. There's a lot of educational materials that are starting to appear in Turkish as well. It's not just impact investing and types of financial models, but it's also about topics such as SROI and things like that, and how finance, conventional finance, can learn from social impact, and how finance can actually connect with the social impact world. That's also important. So there are a lot of educational materials that are being prepared, but I think we still have a lot to learn. So, yeah.
So thank you. I think we are end of the time. Thank you everyone for listening to us, and thank you to our panelists for being with us here.